Hello, my name is Bob Kendall, Head of Retail Distribution for Deutsche Asset and Wealth Management in the Americas, and thank you for joining us for our first quarter update. I'm joined this afternoon by Dodd Kittsley, Head of ETF Strategy. Dodd, it's great to see you.
Great to be here, Bob.
So Dodd, let's spend a little time talking about currency hedging. What was a topic that really wasn't discussed much maybe a year ago, definitely not 2 or 3 years ago, has really become a focal point, a center point for many investor conversations. Talk to me about why.
Yeah, investor awareness has increased dramatically on the impact that currency has, both on the risk and return of any international equity investment, whether you're talking a mutual fund, an ETF, an ADR. And we've gone through this recent period where the dollar has strengthened materially and investors are seeing its effects. They're seeing its effects on returns, and that's probably the reason why the attention and the awareness has grown so quickly in such a short period of time. But they're also seeing its impact on returns and on the diversification benefits that international equities can deliver. For the return side of the ledger, a great example is just developed markets holistically, measured by the MSCI EFA index. When you look over the last 12 months, the stocks in that index have returned 18.5%, yet the experience for a US investor who bought the exact same stocks in the exact same weights in an unhedged format was actually a loss of 0.5 percentage point. That's 19 percentage points difference in opportunity cost, completely attributable to a stronger US dollar.
Interesting. Yeah. Dodd, for those that are watching, I mean, it seems like a relatively easy concept, but talk to me how it actually works, whether it's in an ETF format, it's in a mutual fund format, and also talk to me a little bit about why Deutsche is very much at the forefront of this, much based on a long heritage of currency investing. Talk to me a little bit about that.
Yeah, let's start with the first, and certainly I think a lot of folks look at currency hedged ETFs initially and think that they're complex products, and that couldn't be further from the truth. They're actually arguably more straightforward, more efficient, and a simpler type of investment than what investors are used to, and that's an unhedged type of an investment. And the way we manage our products, whether it be a mutual fund or an exchange traded fund that's currency hedged, is essentially we have two positions. We have the underlying stocks, and then we have a series of 1-month currency forwards designed to neutralize the notional exposure that you have to currencies that's inherent with buying those stocks in the first place. So said another way, you have the stocks, which have exposure to their performance as well as a currency, and then you've got the currency hedge or the 1-month currency forwards that neutralizes that currency, takes it out of the equation, leaving you with just the exposure of the underlying securities.
Now let's shift gears a little bit. Talk to me about the impact that currency really has on volatility and diversification of international equities for the U.S. investor.
It's such an important question. I think investors are becoming more and more aware of those benefits in addition to the benefits of returns. What we've seen is by neutralizing currency, by taking currency out of the equation, in most instances it does lead to a smoother ride, a less volatile type of investment. And this is particularly prevalent in emerging market investments. When you think about emerging markets like Brazil or Russia, in the massive moves that we've seen in their currencies over the last 12 to 18 months, it makes a lot of sense. Overall, when you take a look at the MSCI Emerging Markets Index, for example, over the last 5 years, we've seen annualized standard deviation almost cut in half by taking currency out of the equation, where the hedged version has a standard deviation of around 12%, and the unhedged, which has currency, has a standard deviation of 18%. That's a big difference, and one of the reasons why I think a lot of investors are becoming more interested in currency hedging emerging markets.
Yeah. Talk to me a little bit about Deutsche DeAWM's view of currencies. What are we expecting for the remainder of this year? And then obviously the embedded question in that, have a lot of investors missed the boat? Is investing in currency hedge products a relevant idea on a go-forward basis?
It's such an important question. In fact, the most frequent one that we get from clients is, have I missed the trade, if I missed the boat. We have strong conviction that that is not the case, that we are just entering into the fourth year of potentially a 6 to 8 year secular dollar bull market. And we base that on a couple different things. First, from historical perspective, typically periods of dollar strength and dollar weakness have a duration of about 8 years, and the magnitude of those moves typically is around 55%. We have seen a movement so far of the trade-weighted dollar of up about 30%. So we still think there could be close to a 20% movement still. A lot of that is focused on dollar-euro. Our official forecast for dollar-euro is to be at parity by the end of the year, from 109 today, be down to 90 cents by the end of 2016 and 85 cents by 2017. That's a big, big move, and one where if investors don't want that exposure, they have the ability now to be able to control for that and isolate and get the exposure that they want, which is really the stocks.
Yeah, and it's I mean, we've got a couple of years left at a minimum in just what Deutsche is seeing.
Absolutely, yeah, and fundamentals back that up so much as well. You know, when we see the divergence in terms of central bank policy and what's happening and contrasting the Fed, which many are expecting to raise rates, and what's happening with the Bank of Japan and the ECB, the capital flows that we're seeing out of European assets and investments and into U.S. treasuries and other fixed income. There's so much on the side of the ledger of being a dollar bull going forward and not much to support dollar weakness or to lead one to believe that the dollar could potentially weaken.
Yeah. Now, before I let you go, obviously currency hedged investing has really become mainstream, but very recently. And we've seen a real explosion in the amount of assets that are following these strategies. Sure. Talk to me about, I mean, you've talked a lot about it, but what do you think is really driving it? What are investors getting out of currency hedge investing?
Investors are really getting a investment that reflects their view, and it allows them to control for risk in a way that they never were able to do before. Now, currency hedging is not something new. Institutions have been doing it for decades and decades, but for most investors, unfortunately, most of their choices out there have been unhedged types of options. It's really a sea change that allows investors to have a more precise investment and be able to participate in the exposures they want and eliminate those that they don't.
Yeah. Dodd, as always, really great to see you. Congratulations on all the success of the organization, and we look forward to seeing you at the end of the second quarter.
Thank you very much.
Carefully consider the fund's investment objectives, risk factors, and charges and expenses before investing. This and other important information can be found in the fund's prospectus, which may be obtained by calling 1-855-329-3837 or by viewing or downloading a prospectus. Read the prospectus carefully before investing.